In this video, we'll go over 10 AI stocks to profit from the rise of AI.
I want to go over an AI stock that could 50x in value.
The last one people say can 50x in value, so we should probably take a look at it. The first stock is Microsoft. But what has Microsoft got to do with AI? Well, a few years ago, they purchased a big stake in arguably the most important AI company, OpenAI, which runs ChatGPT. In 2022, ChatGPT shocked the world. When it launched, it immediately gained 100 million users. And as of February 2025, they had 400 million, and now they have 800 million. Put simply, they are growing like crazy. Just to put that into perspective, Twitter has 600 million monthly active users, and Instagram has 1.5 billion. So ChatGPT are right there in the mix. But with ChatGPT, people aren't using it to send funny memes or put some extravagant opinion out there. They are using it to get educated, code, and think critically. This stock, with owning a decent stake in ChatGPT, can certainly benefit from AI. But I can tell you, it's never gonna 50x in price like people say this last one could. Palantir has always been a stock that has confused me. The longer that this stock has been on the market, the higher its PE ratio has become, and now it's selling for a price to earnings ratio of 560. We need to ask ourselves, why are investors willing to pay such higher price for this stock? A core reason is because of the AI narrative behind Palantir. AI is just soaked into everything that Palantir does. Palantir uses AI to clean, link, and organize massive data sets automatically. It gives users AI-powered insights where they can ask a question and Palantir's system will give them a forecast and detect risks. Even with the defense part of the business, Palantir runs AI on drones, tanks, and battlefield systems for real-time decisions. As AI adoption grows, more companies are going to need the types of AI insights that Palantir provides. And their revenue proves this. They've grown from 595 million in revenue in 2018 to 2.9 billion today. And everyone who said they wouldn't be profitable, they have been proved completely wrong. As we go along, you'll start to notice that each one of these stocks has a different play on the AI game. Microsoft benefits from AI chatbots. Palantir benefits from companies needing AI insights into complex systems. Accenture benefits through AI consulting. Accenture helps their clients integrate AI into their clients' own systems. This includes helping their clients automate tasks, creating AI chatbots, and giving machine learning for predicting sales. Every big company knows that AI is the future, but they need a service like Accenture to make it happen for them. If we go to Forecaster, it shows us that Accenture stock is selling for a reasonable PE, at least compared to the market average. And the reason is because they are a relatively mature company. It was founded in 1989. For an AI tech company, that is old. And of course, generally with companies, the older they are, the lower the PE gets. Except obviously not in the case with Nvidia, but we all know why that is. So the structure is, as we go through these stocks, the risks will increase, but so will the potential rewards. So keep that in mind as we get through these and think about your personal risk tolerance. Snowflake is the company that Warren Buffett's company bought into at its IPO in 2020, but since then they have sold their shares. Straight away, if we dig into the fundamentals with Forecaster, you can get a feel for why they sold. You know, kind of like Amazon when they first started, they are just burning through cash. That profit figure is getting deeper and deeper into the negative. But flip it around, the sales, aka the revenue, is on fire. 96 million to 3.6 billion in 6 years' time. That's quite an achievement. So clearly there's a bunch of businesses that really use Snowflake. Snowflake could be very important in the modern age because three things AI needs is clean, accessible, and fast data. And this is what Snowflake as a company provides. If the data doesn't have these three things, either AI will give you bad insights, no insights at all, or insights that take a long time to get. If you dig into their latest earnings call, you can see that their AI focus has been paying off with over 5,200 accounts using AI and machine learning weekly, and Cortex AI, which is Snowflake's AI platform, has become a foundational pillar of enterprise AI strategies. Crowdstrike has been a stock that has really taken advantage of the AI boom. Since 2020, you can see that Forecaster shows us the stock is up 300%. A portion of this is because AI cyber threats have increased over these years, so in turn, AI cyber defense has been more in need. And this is where Crowdstrike comes into the picture. They are a cybersecurity company that protects computers and servers from hackers using AI. Crowdstrike offers a real-time detection engine which analyzes trillions of events per day using AI. This gives them an edge over legacy vendors like McAfee, who haven't incorporated AI as smartly. The AI bull case is that in the future, AI is going to be used even more by hackers, and therefore, cybersecurity companies that use AI for defense are going to be even more important. A bear case is, well, this company has really struggled to put together profitable years, even though their revenue has increased. So these bears would argue, why on earth is Crowdstrike a $100 billion company that struggles to make any money? Risk versus reward, that is the name of the game when it comes to investing. Okay, now we are starting to get into the spicier AI plays. These companies are deep into practically using AI to change the way business is done. The last one is the spiciest of them all. People have projected 50x returns on the stock, so at the end we'll get into if this actually has some legitimacy. Okay, quick overview on ServiceNow and its AI use case. ServiceNow is a cloud software company that helps large organizations automate workflows. That's big. Think about it. Automate workflows. Automate means done automatically by itself without needing human effort. For example, with ServiceNow, you can automate a business's help desk. A customer can get all of the information that they need through a genius chatbot trained on the company's data instead of an employee having to sit there all day answering questions. The nice thing about ServiceNow is there is a high switching cost. Once a business is using ServiceNow, it is deeply ingrained in the day-to-day running of the business. So if a client wants to switch to a different company, it will cost them a lot of time, a lot of money, and a lot of effort. They will only switch almost as a last resort, and this is what Warren Buffett would call the moat of the company. Because most of ServiceNow's customers are Fortune 1000 companies, you have very wealthy clients who need ServiceNow for their day-to-day running of the business. So you can find ServiceNow under the ticker symbol NOW on the New York Stock Exchange. You can see that since the AI boom, it's been one of those stocks that has really taken off, and if they keep doing things right, it could play an important role in the future. It's now an almost $180 billion company. They've grown their revenue a lot, like some of the previous stocks, but unlike some of those other stocks, it has not struggled to clock in a profit. They've been able to make money, which is a positive signal. So this one may be the most revolutionary company out of the whole list, and you'll see why soon. Warehouse and distribution centers for the last 50 years have largely gone unchanged. They involve tedious, slow, and expensive systems to get the job done. Why? Because they often involve humans. Human workers pick, sort, and move goods in a slow, expensive, and sometimes error-prone way. Symbotic replaces manual labor and rigid systems with AI-powered robots that move and sort goods faster. These AI robots can work 24/7. They use smart algorithms to reduce mistakes. They're faster, they're more accurate, and they're more scalable. At the end of the day, a robot is always going to beat a human at most manual tasks. So Symbotic have had the foresight to see this solution for a long time. They developed their first prototype in 2005, and they've been working on it since. And today they have scaled where they're working with the likes of Walmart, Target, and Albertsons, to name just a few. The stock, they're still a $5 billion company, so towards the lower end in size that we generally look at. And as you can see from the P&L, they don't have a proven business model yet. So a bit of valuation, they are $1.8 billion in sales, which gives them around a 3x price to sales ratio. And those sales have really boomed these past few years, as have many of these AI stocks. So if it keeps booming and they find a way to make it profitable, profitable, Symbotic could take off. So the data that I'm using is from Forecaster, who are the sponsor of this video. They make investing a lot easier. You know, one of the ways you get a good feel for what's actually going on with a company is through reading the earnings call transcripts. And obviously this can be a hard read, but it is important to read and listen to the people who run the company and see what they are saying about it. One instrument that makes things so much easier is Forecaster's AI agent, which does the reading for you and sums up the important things in an easy to read manner. Like, which is easier to read, this or this? So with Forecaster's AI agent, we can see that revenue has done well. It's grown 40% year over year, and they have more than doubled the number of operational systems compared to the same quarter last year. They acquired Walmart Advanced Systems and Robotics to expand their product portfolio. However, they still reported a net loss. Management are saying that there may be potential impacts of tariffs, particularly from Europe, on gross margins, and they've had problems with lumpy system starts. So unlike a stock like Coca-Cola, it is not a proven profitable business model yet. And this speaks to a greater point, which is whenever people ask me, well, aren't these AI stocks risky, Cooper? Yes, of course, they are risky, especially these last 4 or so stocks. They are yet to be proven as long-term businesses where you sell a product or a service and you make a good profit. So you are essentially betting or speculating, depending on how well you know the industry, that in the future they will be able to consistently make high profits for shareholders, and that's where this whole risk to reward aspect of investing comes in. With that in mind, please do your own research so that you can deeper understand the rewards on the table, but also the risk. So we have 2 more stocks to go before we get to the 50x stock, and on the way I'm going to show you an important piece of information that you need to know about each one of these stocks. Stock 8 is UiPath, and it is a stock that has been absolutely decimated over the past few years. It was selling for $80 a share in 2021, and now it is selling for $10. So that's a decrease of 86%. However, the fundamentals have improved. Sales are up from 600 million to 1.4 billion in that same period, and net income was minus 90 million and now it is minus 70 million. So still negative, but not as negative. And UiPath is a company that specializes in robotic process automation. And this is the technology that uses software to automate repetitive tasks that are usually done by humans. So to give you an example, a typical human job is to check emails, look for invoices, and then manually type that data into an Excel spreadsheet. And this can take up to half an hour per item and will cost a business a full-time salary. UiPath solves this by just getting a bot to do the job instead. So the bot monitors the emails, and when the invoice comes, it will download it automatically, and then it uses document understanding to extract all of the relevant data onto a spreadsheet in just seconds. What used to take a human half an hour to do, the bot can do in seconds, operates 24/7, and has far fewer errors. Also, you don't have to pay the bot a 60k a year salary, which is quite nice for a business. That is just one of hundreds of examples of how UiPath automates tasks normally done by a human. And just think about all of these low-level jobs that cost businesses hundreds of thousands of dollars every year that can be automated with UiPath. That's a very big market that UiPath can disrupt if they execute effectively. Still risky because although the opportunity's there, only time will tell if they can grab it. And if they don't grab it, well, you can say goodbye to your investment. So what you will notice is that with most of these stocks, I have given you the bull case reasoning behind the stock. In a minute, I will show you a different perspective behind these stocks. But first, we've got to talk about stock 9. So have you ever heard of the phrase, in a gold rush, don't dig for gold, sell shovels? The underlying message says, instead of chasing the risky, hyped opportunity, like mining for gold, make consistent money by selling the tools that everyone chasing the opportunity needs, like selling shovels. Super microcomputer is basically following this concept. In some sense, AI is the modern day gold. Super micro are not making the AI models, but they supply the gear that everyone needs to run them. They design and manufacture high performance AI server hardware, the kind used in data centers running AI workloads. They're a close partner with Nvidia, integrating Nvidia's H100 and GH200 chips into their server racks, and with AI training and inference demand exploding, Super Supermicro is selling more units than ever. Unlike Dell or HP, Supermicro lets customers tailor servers to specific needs, more power, cooling options, or rack sizes to name a few. And this is a huge advantage for data centers who do need to fine tune for AI. So let's just look at the stock numbers with Forecaster. So Supermicro Computer, you can find them under the ticker symbol SMCI. It's a $26 billion company selling for a PE ratio of 25. So it's about half the price to earnings ratio of Nvidia. And with the type of growth and fundamentals that we've seen with this company, it is surprising that the PE ratio is at the sort of lower level. I mean, look at this revenue growth. Went from 3.3 billion in 2018 to 22 billion today. Net income went from 46 million to 1 billion. What's that, 20x? And basically every year they have managed to be profitable, which is something that I really like in a company. It shows that they can be disciplined and keep a margin instead of just spending everything. Some of the other companies in this list, they are not established like Supermicro and have yet to prove that they can consistently make profits. And this is one of, I'd say, the two key risks that come with these AI stocks. If you buy a business like Coca-Cola, you know every year that they will sell a ton of Coke, generate a lot of earnings, and pay a dividend around 2 or 3%. If you buy a business like, say, UiPath, they don't have such a consistent business, and thus you are taking a risk and betting that in the future it will be profitable. It's a big opportunity, but it's not realized yet. So risk 1 is what I call business risk, and risk 2 is what I call price risk. Whenever you pay a high price for something, added risk comes attached. Why? Because you have more to lose. Also, the stock in the future needs to generate more earnings so that they justify your high price tag. Our job as investors is to understand the risks and use our understanding to see how big these risks are compared to the potential reward. If you invested in Tesla stock 15 years ago, people said it was very risky. Electric cars sold en masse, that's never going to happen. But obviously it did happen, and if you had the understanding, you would have known that the odds were in your favor. So please, before you buy any stock, look to gain a solid grasp on the stock before buying. With that in mind, let's move on to this stock that people say can 50x, and let's try understand if this is true.
I want to go over a pretty unique opportunity in this video. An AI stock that could 50x in value, potentially 100x. Wall Street doesn't know about this company yet. And I'll show you why that is, why it's so attractive, the massive institutional backing, and the massive market opportunity. If you don't already know, this company is Rezolve AI.
Okay, first we'll quickly try understanding the company, and then we'll see why investors like this gentleman are so bullish on it. I can't lie, it is a unique goal that this company is chasing. When a shopper walks into a physical store, they are more likely to buy something than if they browse online. The problem with online stores is, yes, they get a lot of traffic, but this often does not convert to sales. And this is where Rezolve AI comes into play. They use AI to help retailers sell and convert at a higher rate. A key way that they do this is through a shopping assistant. Instead of having to browse endlessly online, the customer can just ask the online assistant, say, I want waterproof running shoes under $100, and the assistant finds it for them straight away. In some cases, the user can buy what they want directly through the chat. Rezolve's shopping assistant, the Brain Suite, can be embedded into retail websites, mobile apps, messaging platforms, and even in-store kiosks. It's a big market that Rezolve can potentially disrupt. I can see why some investors like the stock right now, but let's take a look at the numbers and see why these investors say they like it.
What they're doing now is exciting. First and foremost, you have a market cap of $687 million. Look at this. Rezolve AI locks in $70 million of ARR months ahead of planned. Now on track to exceed 100 million ARR by year end. That means if they can exceed or hit $100 million in ARR, nevertheless exceed that, they are trading at roughly a 6 to 7 times price to sales metric. That is cheaper than any of your other high-flying AI stocks right now. That is cheaper than BBAI. That is cheaper than SoundHound.
Yeah, that's the bull case scenario. I did a little bit of digging into the stock, and the numbers aren't great, at least as of right now. You can see that they're consistently losing a lot of money each year. That's net income, aka profits. And then on top of this, they are basically making pennies in terms of revenue. Not to say that in the future they can't turn this around, and as the guy said, they have reportedly locked in 70 mil in ARR, which can potentially exceed 100 million by year end. Alongside their strategic partnerships with Microsoft and Google, this is pretty positive news, but it's certainly not a guarantee and is very risky. There's a reason why the stock has crashed 74% since July 2024. This brings me to a greater point about all of these AI stocks, which is that AI is going to disrupt a lot of industries and there's a big opportunity, but there's still so much risk that comes along too. Just like in the internet era in 2000, yes, we got Google, Amazon, and Facebook, but for those three successes, there were thousands of failures that came too. I just want to say thank you to Forecaster for sponsoring this video. Don't forget to check the link in the description or pinned comment if you want to use this great website. It's well designed and incorporates AI to make analyzing stocks quite a bit easier.